Fundamental analysis is the art of understanding a country's economic health. It's kind of like being a doctor for an economy. You look at vital signs to see if it is strong or weak. In Forex, these vital signs are economic data releases. They tell us everything from how many people have jobs to how fast the economy is growing. A healthy economy usually means a strong currency. This is because international investors want to put their money where it will grow safely. They buy that country's currency to invest, which in turn drives up its value. This is really the core principle that every Forex trader must understand. Why should you care about this? Well, it's because currencies do not move in a vacuum. Their prices are a direct reflection of supply and demand, which are heavily influenced by economic performance. Imagine you are deciding between two companies to invest in. You would look at their sales, profits, and growth plans. Fundamental analysis is the same process but for entire countries. By understanding a nation's economic story, you can make educated guesses about the future direction of its currency. It provides the why behind the price movements you see on your charts every single day. Many new traders focus only on technical analysis, which is the study of price charts. They look for patterns and trends, which is a valid strategy. However, ignoring fundamental news is like driving a car while only looking in the rearview mirror. The charts show you where the price has been, but economic news tells you where it might be going next. A surprise announcement about interest rates or a shocking jobs report can instantly reverse a trend. This is why professional traders always have an economic calendar open. The first major economic indicator that every trader watches is gross domestic product, or GDP. Think of GDP as the total report card for a country's economy. It measures the value of all goods and services produced over a specific time, usually a quarter or a year. When GDP is growing, it means the economy is expanding. Businesses are producing more, people are spending more, and the country is becoming wealthier. For a currency, this is very good news. A strong GDP report attracts foreign investment, which increases demand for the currency and typically causes its value to rise against other currencies. Next, we have inflation, which is measured by the Consumer Price Index, or CPI. Inflation is simply the rate at which the general level of prices for goods and services is rising, and, as a result, purchasing power is falling. A little bit of inflation is usually seen as healthy for a growing economy. However, if inflation gets too high, it erodes the value of a currency. To combat this, a country's central bank will often raise interest rates. Higher interest rates make holding that currency more attractive to investors seeking better returns, which in turn strengthens the currency. Traders watch CPI reports very closely for clues about future interest rate decisions. The third critical piece of data is the unemployment rate. This indicator tells us the percentage of the labor force that is jobless but actively looking for work. A low unemployment rate is a sign of a robust economy. When more people are working, they have more money to spend, which boosts economic activity and growth. This is positive for a currency. Conversely, a rising unemployment rate signals economic trouble, which can weaken a currency. The monthly United States non-farm payrolls, or NFP report, is perhaps the most watched jobs report in the world, often causing massive volatility across all major currency pairs within minutes of its release. These three indicators, GDP, inflation, and unemployment, are deeply interconnected. For example, low unemployment can lead to higher consumer spending, which can boost GDP. However, it can also lead to higher wages and increased demand, which can push inflation up. Central banks must perform a delicate balancing act to keep all these factors in check. As a trader, your job is not just to know what these numbers are, but to understand how they relate to each other and what they signal about the central bank's next likely move, because that is what truly drives currency prices. Professional traders don't just read the news, they anticipate it. Weeks before a major announcement like a GDP or jobs report, economists and analysts publish their forecasts. These forecasts create what is called market expectation. The actual price movement on the day of the release depends on how the real number compares to this expectation. If the actual number is much better than expected, the currency will likely surge. If it's much worse, it will likely fall. If the number comes in exactly as predicted, the market may not react much at all, because the news was already priced in by traders. Let's walk through a clear example. Imagine the market expects the United States to report it added 180,000 jobs in the last month. You are watching the EUR-USD pair. If the non-farm payrolls report is released and shows a stunning 250,000 jobs were added, This is a huge positive surprise for the United States economy. Traders would immediately start buying United States dollars, believing the Federal Reserve might raise interest rates sooner. As a result, the value of the USD would rise, and you would see the EUR-USD price fall sharply as the dollar strengthens against the euro. Conversely, consider a scenario with an inflation report. Let's say the market expects the annual inflation rate in the United Kingdom to be 2.1%. However, the official report comes out at a low 1.5%. This is a negative surprise. It suggests the economy is weaker than thought, and the Bank of England will be less likely to raise interest rates. Traders would quickly sell the British pound. On a chart of the GBP-JPY pair, you would see the price plummet as the pound weakens significantly against the Japanese yen. The key is the surprise factor. The bigger the deviation from the forecast, the bigger the market move. This process of trading the news requires preparation. Before a big release, traders will check the economic calendar for the exact time of the announcement and the consensus forecast. They will then form a plan. If the number is above X, I will buy. If it is below Y, I will sell. Some traders even place pending orders just before the release to catch the initial spike. However, this is risky due to slippage, where your order gets filled at a much worse price than intended because of extreme volatility. A more cautious approach is to wait for the initial chaos to settle and then trade the new trend that emerges. To successfully trade based on economic news, you must be organized and disciplined. The first step is to always keep an eye on a reliable economic calendar. Websites like Forex Factory, DailyFX, or Investing.com provide free calendars that show all upcoming data releases, their level of importance, and the market's consensus forecast. You should check this calendar at the beginning of each day and each week. Identify the high-impact events for the currencies you trade, and be aware of the exact time they are scheduled for release. This simple habit prevents you from being caught off guard by a sudden market-moving event. Next, you need to understand the context behind the numbers. Don't just look at a single data point in isolation. Ask yourself, what is the current trend? For example, if inflation has been rising for several months, another high reading will reinforce the idea that the central bank will act soon. However, if a high inflation number comes after a long period of low inflation, the market might dismiss it as a one-time event. You need to connect the dots between different reports. A strong GDP report combined with a low unemployment rate paints a much more powerful picture than either one on its own, building a strong case for a currency's strength. When a major news event is about to happen, managing your risk is paramount. The moments surrounding a big release are often the most volatile. Spreads can widen dramatically, and prices can jump dozens of pips in a single second. For this reason, many experienced traders advise against holding an open position right through a high-impact news release unless it is part of a long-term strategy with a wide stop-loss. It is often smarter to wait for the dust to settle. Let the initial knee-jerk reaction play out, and then look for a clear entry point based on the new market sentiment and trend that forms in the aftermath. In conclusion, weaving fundamental analysis into your trading strategy is not optional, it is essential for long-term success. By understanding what key economic indicators like GDP, inflation, and unemployment mean, you can begin to predict how central banks will behave. This in turn allows you to anticipate major shifts in currency valuations. Start by following the economic calendar, learn the market's expectations, and watch how prices react to surprises. This disciplined approach will help you make more informed, confident, and ultimately more profitable trading decisions in the dynamic world of the Forex market.